Welcome back to the Daily Morning Crypto Feeds on Cove Markets, with me as editor Olivia. Today, let's take a look at some notable crypto news in the past 24 hours. Thank you for always supporting and accompanying us. Come to the following hot news. Bitcoin and Ethereum inch higher, BNB and Sol outperform, flow rallies. How to spot the next Celsius before it's too late. Bitcoin and Ethereum inch higher, BNB and Sol outperform, flow rallies. Bitcoin price is facing a strong resistance near the 23,500 United States dollars level. It is currently 3:51 Coordinated Universal Time, trading near 23,300 United States dollars and is up over 1% in a day and is unchanged in a week. Similarly, most major altcoins are attempting a fresh increase. ETH moved above 1,700 United States dollars and might accelerate if it clears 1,740 United States dollars. XRP is still below 0.380 United States dollars while ADA surpassed the 52 United States cents resistance zone. Bitcoin price. After a short-term drop, Bitcoin price remained above the 22,500 United States dollars support zone. BTC formed a base, started a decent upward move, and settled above the 23,000 United States dollars level. The bulls even cleared the 23,200 United States dollars level, but they are facing resistance near the 23,500 United States dollars level. The next main resistance is still near the 23,800 United States dollars level. A clear move above the 23,800 United States dollars resistance zone could initiate a stronger increase. On the downside, an immediate support is at 23,000 United States dollars. The next major support is near the 22,500 United States dollars zone, below which the price could start a stronger decline. Ethereum price. Ethereum price is back above the 1,700 United States dollars level, but there are many hurdles on the upside. ETH is up almost 2% in a day and a week. An immediate resistance is near the 1,740 United States dollars level. The next key resistance is near the 1,780 United States dollars level, above which the price might gain bullish momentum. In this case, the price could rise to 1,880 United States dollars. ADA, BNB, Sol, Doge, and XRP price. Cardano, ADA, is moving higher and was able to climb above the 0.520 United States dollars resistance zone. The next key resistance is near the 0.535 United States dollars level, above which the price could test 50 United States cents. BNB is showing positive signs above the 320 United States dollars level. It is also trading above the 325 United States dollars level and might continue to rise. BNB is up almost 5% in a day and 15% in a week. If the bulls remain in action, the price might even test 340 United States dollars. Solana, Sol, is up 5% and trading above the USD 41 level. An immediate resistance is near the USD 42 level. A clear move above the USD 42 level might send the price towards the 45 United States dollars level. Doge is struggling to gain pace above the 0.0700 United States dollars level. A close above this level might start a stronger increase. In this case, the price might rise towards the 0.0720 United States dollars level. XRP price is still trading below the 0.380 United States dollars resistance. The first major resistance is near 0.388 United States dollars, above which the price might rise towards the 40 United States cents level. Other altcoins market today. Many altcoins are also moving higher. AVAX, Link, Near, Crow, Atom, XLM, Flow, Theta, EGLD, and QNT. Out of these, Flow rallied 11% and surpassed the 2 United States dollars and 90 cents level, increasing its weekly gains to 51%. Overall, Bitcoin price is still facing a major resistance near 23,500 United States dollars. If BTC clears the 23,500 United States dollars barrier, it could gain bullish momentum. How to spot the next Celsius before it's too late. It's every crypto investor's worst nightmare, depositing money with a platform that later goes bust, making it all but impossible to recover funds. It's also bad enough investing in the native token of any such platform, the collapse of which will send that token plummeting to earth like a lead balloon. This nightmare has already been realized on more than one occasion during the current bear market, with the collapses of Terra and Celsius leaving more than a few investors out of pocket. Yet while we can all point retroactively to how dangerous such platforms and their business models were, spotting the next Celsius before it collapses is certainly a big ask. However, a number of crypto industry players affirm that, at least in the worst cases, there are a few telltale signs that reveal some platforms are exposing themselves to more risk than others. At the same time, a diversification strategy always remains a sound policy, since predicting the next collapse in a highly interconnected market isn't always possible. Telltale signs of the next Celsius. Pretty much every commentator is in agreement as to the primary telltale sign of vulnerable platforms: unusually high yields. Yes, Celsius and Terra, via the associated Anchor protocol, offered yields that seemed too good to be true, or rather, too risky to be true for long. At the very least, Celsius displayed a woeful lack of due diligence in lending vast amounts of depositors' money to highly speculative ventures. But the way it made such lofty promises of high returns to sign up and lock away their money had many hallmarks of a giant Ponzi scheme, said Susanna Streeter, the senior investment and markets analyst at Hargreaves Lansdowne. Streeter advises that speculators should treat incentive schemes that reward holders for not selling, and that charged as who do, with suspicion. Likewise, global block analyst Marcus Soteru also flags high yields as a major warning sign of a potentially risky platform. This touches on another big risk factor: using investors' and depositors' funds to speculate and trade on other platforms, many of which carry their own risks. In fact, this almost always tends to occur with the offering of high yields, since it's really the only possible way of providing such yields, unless a platform is an outright Ponzi scheme. These platforms were characterizing themselves as deposit takers and alternatives to banks, but were investing client funds in various, sometimes aggressive trading strategies to fund the high yields offered to attract those deposits, said Charlie Beach, the chief risk officer at Nasdaq-listed crypto exchange EQONEX. One of the big issues with investing with user funds is that, if investors withdraw liquidity faster than investors deposit, then a platform would be at risk of not having enough liquidity to fulfill its withdrawal obligations. Of course, it's not always transparent as to what exactly a DeFi platform is doing with its users' funds, yet users should endeavor to find out, and if they can't, they should probably steer clear. And aside from the inherent volatility of the crypto market, platforms also have to be wary of hacks and other technical mishaps. These are also not uncommon in crypto, something which Celsius discovered, much to its chagrin. It started in June 2021, said Marcus Soteru, when Celsius lost at least $35,000, USD 58.8 meters today. According to on-chain data provided by Nansen, in the Ethereum staking service Stakehound. In addition, according to an analysis by Dirty Bubble Media, Celsius lost USD 22 meters from the Badger DAO hack after it mistakenly forfeited restitution payments. Crypto and contagion. Unfortunately, more than a few analysts and industry figures affirm that risk is almost unavoidably amplified in crypto, given its immaturity. This will make picking out the next Celsius more than a little difficult. Much of the innovation and programs we see around digital assets are still experimental, and with only 5% global penetration, the liquidity base is not strong enough to withstand extreme market stress, and with over 20,000 cryptocurrencies in the market, liquidity is even more stretched out, leaving the market more vulnerable than it needs to be, said Ben Caselin, the head of research and strategy at Hong Kong-based crypto exchange AAX. While it's not exclusive to crypto, the sector is also defined by the regular use of leverage, something which amplifies risk and exposes platforms to some very big come-downs. This reliance on leverage may subside to an extent as the market matures and becomes more liquid, but for now, it's another factor that makes crypto riskier than many other areas of investment. Crypto assets are intrinsically risky and require careful risk management, but the industry is only starting to learn that lesson in a painful way. When asset prices were increasing, hedge funds and lending platforms were borrowing with insufficient collateral and often using those funds to trade inherently risky trading strategies with leverage, said Charlie Beach. One other issue affecting crypto as a whole is that of contagion, with many platforms lending to and/or depositing with each other. This is another magnifier of risk, and makes spotting a future bankruptcy particularly difficult. Contagion has impacted many collapses and bankruptcies, with lenders being impacted the most due to a liquidity crisis. The contagion has meant that lenders have been forced to withdraw credit from the system to reduce risk, which has a knock-on effect and resulted in many lenders struggling to meet withdrawal obligations, said Marcus Soteru. The future needs to be transparent. On the other hand, contagion isn't unique to crypto, with the legacy financial system also exhibiting strong interconnectedness. However, in the main, traditional financial firms have done a better job of avoiding bankruptcies in recent years due to more advanced and rigorous risk management. As such, the crypto industry needs to significantly improve its risk management practices, making them stricter and more systematic. This is the only way to minimize the threat of contagion and avoid dangerous market behavior. As an example, Voyager Digital had lent out a total of $2 billion to market participants, and around USD 660 meters of which was lent to Three Arrows Capital. The fact that around a third of funds lent out was allocated to one institution is extremely risky and resulted in Voyager Digital collapsing. If they reduced the total exposure to Three Arrows Capital to 5% of lent funds, their collapse could have been avoided, said Marcus Soteru. On top of better risk management, some would like to see regulators getting involved, if only to protect retail investors. Recent collapses will intensify the urgency for regulators to start imposing more rules on the crypto world to ensure that more retail investors are prevented from getting caught up in the hype and gambling with money they can ill afford to lose, said Susanna Streeter. As for retail investors, there are a few things the average trader can do to reduce their exposure to the next Celsius. In addition, investors should also carry out their own due diligence to find out what the platform they are investing with is doing with their funds, especially if the platform does not make this clear and transparent on its website. And again, if a platform doesn't provide transparency, then perhaps it would be better to avoid it. And those are also the most outstanding news that closes the morning of August 8th. Thank you to everyone for listening and following Cove Markets' daily news. If you find the video interesting and useful, please click like and subscribe to our channel so you don't miss any of the latest crypto news.